If I suddenly woke up in 2026 with $0, no investments, and had to rebuild my finances from the ground up, but still kept all the investing knowledge I have today, I would be miles ahead of where I started the first time. When I made my very first investment years ago, I didn't have clarity or a system. I spent countless hours researching random stocks, chasing hype, and guessing which company might explode next. That approach cost me time, money, and unnecessary stress. What I eventually learned is simple but powerful. Successful investing isn't complicated, it's consistent. So in today's video, I'm walking you through exactly how I would start investing from scratch in 2026, step by step, to build wealth faster, reduce risk, and avoid beginner mistakes. This is a complete beginner roadmap for the US stock market. Imagine it's the start of a new year and you've managed to set aside $10,200 in cash. Now you're faced with a choice. Do you save it or do you invest it? To answer that, we need to talk about inflation. In the United States, inflation averaged roughly 2.7% in 2025 and is expected to stay close to 3% in 2026. That means everyday expenses, rent, groceries, gas, even coffee, slowly become more expensive over time. If your monthly expenses are around $3,400, a 3% inflation rate pushes that closer to $3,500 within a year. You may not feel it month to month, but over time, it quietly eats away at your purchasing power. Now let's say you keep your $10,200 in cash. Prices go up, but your money doesn't. That means your dollars buy less over time, which is effectively losing money without realizing it. A better option than cash is a high-yield savings account. Many US banks currently offer around 3% to 5% interest. At 4.5%, your $10,200 could grow to roughly $1,250 in a year, which helps offset inflation. This is great for safety and short-term needs, but it's still not how long-term wealth is built. When you save money, the bank pays you interest because it uses your money to lend to others. When you invest, you become a partial owner of real businesses. As those companies grow, you share in their success. Take Apple as an example. A single share purchased around 2010 for roughly $10 would now be worth well over $200, not including dividends. That kind of growth is something saving alone cannot match. The US stock market allows everyday people, teachers, students, doctors, and regular workers to invest through exchanges like the NYSE and NASDAQ. Historically, the stock market has delivered average annual returns of 7% to 10% over the long term, even with crashes and recessions included. That's why investing moves your finances forward, while saving mostly preserves them. Not every company succeeds. While Apple thrived, other tech companies from the same era disappeared. Palm is a perfect example. Despite massive backing and celebrity investors, it failed to compete and eventually vanished. Early on, I made the mistake of trying to pick individual winners. I watched endless videos, tracked headlines, and convinced myself I was being smart when in reality, I was taking unnecessary risks. That's when I discovered index funds and ETFs. An ETF, exchange-traded fund, is a collection of stocks bundled together by firms like Vanguard, Schwab, or Fidelity. Instead of betting on one company, you own a small piece of many. For example, SPYM, which tracks the S&P 500, includes the 500 largest US companies such as Apple, Microsoft, Amazon, and Google. When you invest in an ETF, your risk is reduced through diversification. You save time because you don't need to constantly monitor individual stocks. Popular ETFs include SPY, IVV, VOO, QQQ, and QQQM. For beginners, broad market ETFs that track the S&P 500 or NASDAQ are often the smartest place to start. If I were investing today from scratch, I'd likely choose SPYM or QQQM due to their exposure to strong, innovative US companies. There are two situations where I would delay investing. 1. High-interest debt. 2. No emergency fund. If you're carrying credit card debt at 20% plus interest, paying that off is a guaranteed return. Investing while carrying expensive debt is like trying to run with a weight tied to your leg. Before investing, you should have 3 to 6 months of living expenses in a high-yield savings account. This protects you from having to sell investments during emergencies and losing long-term growth. Once those 2 boxes are checked, you're ready. You don't need $1,200 or even $100 to start investing. Many US brokerages allow you to begin with as little as $1. Here's why consistency matters. Investing $1 per month for 40 years at a 10% annual return results in approximately $5,300. Investing $10 per month for 40 years at a 10% annual return results in approximately $53,000. Investing $1,000 per month for 40 years at a 10% annual return results in approximately $5,300,000. The key is starting early and increasing contributions as your income grows. Your first step is opening a brokerage account, which allows you to buy ETFs, stocks, and bonds. ETFs charge a small annual expense ratio. I personally prefer funds under 0.5%, ideally much lower. Some ETFs, like EBSROX, even have a 0 expense ratio. For beginners, I recommend platforms like Fidelity. You'll choose between a Roth IRA, which is tax-free growth for retirement, and a taxable brokerage account. For long-term investing, a Roth IRA is often ideal. Once your account is funded, search for the ETF you want, choose a market order, review and submit. The entire process takes less than 5 minutes. To succeed long-term, automate your investments, stay invested during market downturns, and avoid trying to time the market. Markets recover. Investors who stay consistent are the ones who benefit most. If you follow the strategy I shared today, you'll start investing earlier, smarter, and with fewer mistakes than most people ever do. If I could go back, I would invest sooner and more consistently, and that's exactly why I share this on Invest Insights US. If you're serious about learning how to invest in the US stock market as a beginner, I invite you to join my Beginner Investing Masterclass, where I break everything down step by step. If this video helped you, like, subscribe and turn on notifications so you never miss future investing insights. Your future self will thank you.